This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 28, 2026, and this is the After Hours session. Now, let's get into it. The S&P 500 is grinding near fresh highs, but the market is splitting in two. While the Nasdaq is surging on AI optimism, a major fintech acquisition just imploded, triggering a violent rotation away from speculative growth. We are looking at a market defined by extreme concentration versus structural fragility. Let's get into the data. On the economic calendar, today brings the University of Michigan Consumer Sentiment reading at 11 o'clock a.m. Eastern. This is the last major inflation gauge before the weekend, and with CPI holding at 3.3%, the Fed funds rate at 3.63%, and a flat yield curve, every point of movement here will dictate whether the current tech rally holds or faces a macro headwind. On Monday, we'll see the Dallas Fed Manufacturing Survey, followed by the ISM Manufacturing PMI and JOLTS job openings on Tuesday morning. These are the critical data points that will tell us if the higher-for-longer narrative is finally breaking the real economy or if it's being ignored by equity investors. Here is the snapshot as of 4:35 p.m. Eastern. The S&P 500, SPY, is at $771.10, up 0.66%, trading within a hair's breadth of yesterday's high of $772.36. The Nasdaq 100, QQQ, is outperforming at $721.11, up 1.37%, while the Dow Diamonds lags significantly at $535.22, up just 0.19%. The Russell 2000, IWM, is consolidating at $299.81, up 0.29%. Meanwhile, the VIX is sitting at a complacent 15.21. The headline story is the collapse of PayPal's $50 billion buyout deal, which has triggered a sector-wide rotation where technology is rallying while financials and consumer staples bleed. Let's talk about the headline moving the market. PayPal has gapped down 13.9% to $52.92 after Stripe and Advent abandoned the acquisition. This is a massive structural break in the fintech narrative. Pulse. How does this violent collapse register in the broader sentiment data? It registers as a dangerous dissonance. The VIX is at 15.21, which implies a quiet market, but that number is completely failing to register the shock of PYPL's 13.9% drop. We are seeing a sentiment asymmetry, where AI sentiment is strongly bullish at plus 0.53 across 90 articles, yet we have a former tech leader collapsing. The market isn't just rotating, it's abandoning story valuations for specific profitability signals. We have to watch the put/call ratios for names like AFM closely. If that ratio spikes alongside PYPL decline, that bullish AI euphoria will quickly invert. And while PYPL collapses, a firm, AFM, is gapping up 11.5% to $86.37, following a price target raise from Needham. CIPHER. Why is capital fleeing PYPL and running straight into AFM?
It's a fundamental reset. The collapse of the $50 billion buyout is a hard cap on premium valuations for unprofitable fintech giants. Capital is aggressively rotating from story stocks to profitability stocks. AFM is up 11.5% because it has demonstrated unit economics, whereas PYPL valuation model just got shredded. We are seeing institutional flows prioritize earnings visibility over speculative growth in this sticky inflation environment. The market is pricing in a soft landing for AI winners while actively shorting speculative fintech.
That rotation is fueling the broader market. The Technology Select Sector, SPDR, the technology sector, is surging 3.16% to $188.61, completely decoupling from the broader market weakness in sectors like consumer staples, which is down 1.38%. Grid, where are we technically on the SPY and triple Q as we head into the weekend?
SPY is trapped in a high-pressure consolidation range. It closed at $771.10, which is only $1.26 away from breaking yesterday's high of $772.36. A break above that level would technically target the 10-day high of $778.80. However, the leadership is incredibly narrow. Triple Q is up 1.37% to $721.11, confirming a growth cap-weighted rally, but IWM is stagnating at $299.81, sitting just $2.77 above the critical 10-day low support of $297.04. If IWM breaks below $297.04, it confirms that the rally is not broad-based and we are looking at a market top structure in the small caps.
I have to challenge that technical breakout thesis. You are treating a liquidity-driven tech rally as a broad market confirmation, but you are ignoring the macro ceiling. The 10-year 2-year yield curve is flat at plus 0.47 percentage points. CPI is sticky at 3.3%, and real GDP is decelerating to 1.48%. The market is pricing a soft landing that the data explicitly denies. The technology sector rally is a structural anomaly. It is a high beta fragility masked by a deceptively low VIX of 15.21. The PayPal collapse isn't an isolated event. It is the canary in the coal mine for a broader risk-off shift that the VIX is currently too blind to see.
Let's drill down into the index divergence. SPY is up 0.66% at $771.10, but the Dow Diamonds is barely moving at $535.22, up just 0.19%. This tells us the S&P 500 is being lifted entirely by megacap technology. Grid, what are the specific technical levels for the triple Q as it pushes toward $721.11?
Triple Q closed at $721.11, up 1.37%. It is testing the psychological resistance of yesterday's high of $721.35. We are seeing extreme concentration in AI infrastructure. The 10-day range for triple Q is $702.70 to $734.58. The move to $721.11 is a breakout from the lower end of that range, but it is failing to challenge the 10-day high of $734.58. This confirms the leadership preference for megacap tech over the broader market. The technical reality is that the technology sector's 3.16% surge to $188.61 is actively overriding rate concerns. Capital is not pricing in a recession today. It is aggressively rotating into the top 10 names in the Nasdaq.
But that concentration is the risk. The AI sentiment score is at plus 0.53, which is bullish, but look at the divergence. Meta sentiment is bearish at minus 0.64. This isn't universal market joy, it is selective euphoria. The market is underpricing the contagion risk in fintech because the VIX is at 15.21. We are seeing a quiet market being disrupted by a single high-impact corporate event. If the PayPal contagion spreads beyond one stock, that low VIX will snap back violently. That contagion risk is the central tension. SPECTER, you mentioned the yield curve. How does a flat yield curve at plus 0.47 percentage points interact with this tech rally?
It's a classic euphoria phase. Historically, a flat yield curve is a caution signal for growth stocks. Yet the technology sector is rallying 3.16% while the broader market lags. The market is ignoring the 3.63% Fed funds rate and the sticky core PCE inflation of 3.34%. This is a decoupling from traditional rate-sensitive valuation models. When the yield curve flatlines at plus 0.47 percentage points and inflation holds at 3.3%, the probability of a macro correction is high. The PayPal collapse is a stress test that reveals the underlying fragility. We are seeing a higher for longer tech optimism while abandoning speculative growth. But that optimism is disconnected from the macro reality of slowing GDP at 1.48%.
CIPHER, is there any fundamental justification for ignoring the macro headwinds?
Only if you look at the specific fundamentals of the AI winners. The data shows the technology sector rallying while the broader market SPY plus 0.66% lags. This isn't broad market euphoria. It is a concentrated rotation into companies with pricing power that can withstand a 3.63% Fed funds rate. The PayPal buyout collapse is a fundamental reset for mid-cap fintech. It signals a hard cap on speculative valuations. Capital is flowing into quality AI infrastructure, evidenced by the technology sector surging to $188.61. The market is pricing in a soft landing for AI winners while actively shorting speculative growth. The upcoming earnings for CIPHER, which has an earnings per share estimate of $0.33, will be a key test. If profitability remains the only metric commanding premium multiples, PYPL collapse is the new baseline.
Let's look at the small cap pressure. IWM is at $299.81, up 0.29%. It is consolidating near the $300 psychological level, but it is significantly underperforming QQQ. Grid, what happens if IWM breaks below $297.04?
If IWM breaks below $297.04, which is yesterday's low and the 10-day low support, it confirms a market top structure in the small caps. The 10-day range for IWM is $297.04 to $305.18. It is sitting dangerously close to that support threshold. The technical reality is that the upside in the broader market is fragile. The failure of IWM to hold $300 and the stagnation of small caps suggests that this upside is highly susceptible to a liquidity pullback. We are seeing a clear leadership preference for mega-cap tech, leaving the rest of the market exposed.
And that exposure is where the sentiment disconnect lies. The VIX is at 15.21, which is dangerously low for an environment where we have a flat yield curve and sticky inflation. The PayPal event is a localized sentiment shock, not yet reflected in the broad VIX. We are seeing a quiet market being disrupted by a single high-impact corporate event. If the contagion spreads, that low VIX will not hold. The put/call ratio for AFM is the key indicator to watch. If it spikes, the AI bullishness will quickly invert into a broader risk-off sentiment. Apex synthesize this. We have a narrow tech rally, a fintech collapse, and a flat yield curve. What is the structural picture?
The market is exhibiting a dangerous structural bifurcation. Grid flagged the SPY breakout potential above $772.36, but SPECTER correctly identified the macro ceiling created by the flat yield curve and sticky inflation. CIPHER showed us the fundamental reset in fintech, where PYPL collapse is driving capital into profitability-focused names like AFM. Pulse highlighted the sentiment asymmetry, where AI euphoria is masking broader fragility. The synthesis is clear. That the technology sector surged to $188.61 is decoupling from the macro reality. The PayPal collapse is not an isolated event. It is a leading indicator of a valuation reset. The market is pricing in a soft landing that the data does not support, creating a high-risk environment for late longs at SPY's resistance levels.
To summarize, the S&P 500 is near highs at $771.10, but the rally is extremely narrow, driven entirely by a 3.16% surge in the technology sector, to $188.61. The collapse of PayPal's buyout has triggered a rotation away from speculative fintech, benefiting profitability-focused names like AFM. Technically, SPY is testing $772.36 resistance, but the flat yield curve and low VIX of 15.21 suggest the market is underpricing macro risks. Tomorrow, the University of Michigan consumer sentiment data will be the critical test for whether this tech euphoria holds or faces a reality check. This is ShadowQuant Equities Edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.